The 90-day tariff pause went from being fake news on Monday to being a part of the art of the deal on Wednesday. And markets, well, they exploded to the upside with the major indices up over 10% on the session. That's about the average annual return over the span of just a few short hours. Now it's our job to confirm if the capitulation low is ultimately in. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So as crazy as it might seem for a Wednesday midweek market update, we're starting on the monthly time frame chart for the S&P 500, because if we're thinking about trade location, talked about this on Saturday, is this not an awesome spot for a potential monthly high or low? We have previous resistance, which is now potentially acting as support, and we're still over the monthly 50 SMA. This is the 480 level that we talked about on Saturday, and you can clearly see, as of right now at least, as of today's Wednesday close, we're actually back inside of the previous monthly range, which is insane because that's gigantic in terms of the range that was actually traveled, right? So all things considered, if the capitulation low is going to hold here, it does make sense as a monthly higher low, which aligns with the higher time frame thesis we've set forth based on Saturday's update video. So all set on the monthly time frame, this does check out as a reasonable location for the higher low. Let's drop it on down to a weekly time frame chart and quickly take a look here. What we also talked about on Saturday was that if the capitulation low is going to be in, we needed to see a couple of things. Number one was the potential for a failure pattern. And I don't know about you, but a weekly gap down that is now not providing a gap fill reversal, staying underneath the previous week's low, and that's almost all the way up towards the previous week's open, which was already a very large range, starts to look like a failure from the sellers to extend the losses in the downward direction. Now, I'm not going to sit here and say that there's not the opportunity for a weekly lower high to form on the back test of the bottom end of the range here. That's certainly an opportunity. This could be a weekly lower high, but what we want to focus on going forward is whether or not we can actually spot a daily higher low. The daily higher low will be the next key piece of information to confirm whether or not this is going to hold. What you'll note about all major capitulation bottoms, and we were even sort of subject to being on the wrong side of this when August 5th yen carry trade exploded, right? Is you start looking for that lower high too much, the natural buying activity of the market takes back over, and the next thing you know, you're still looking for shorts by the time you're making an equal high on something like the weekly. So we don't want that to happen, but we should still acknowledge that yes, from a trend count perspective, it is still possible that a lower high could emerge here. However, as mentioned, our focus should be on whether or not we can actually spot a daily higher low. So speaking of the daily, let's take it to the daily time frame chart, and this is just madness. This is crazy. One of this bar, I'm at a loss for words. This will go down in history as one of the most wild trading sessions of the market's history. If we take a look at the trend count here, right, we know that we had highs, we know that we had lower highs, and the weekly lower high and everything that we just talked about is still well and good, and you could still say that it's possible a daily lower high could be found here, but that's not what we're thinking about. The main premise of what I was just describing on the weekly was such that any pullbacks here that can hold a higher low over the 523.75 top end of the balance range here, that starts to become very constructive for the market turning the capitulation low into a structural low. So sure, the market can pull back. I mean, let's be honest with ourselves. The market rallied over 10% on today's session. Would it be unreasonable for a little bit of a pullback to unfold here in the context of an overall weekly downtrend still, an overall daily downtrend? Of course it wouldn't be unreasonable. But if the market can suggest that a higher low is to be found over 523.75, the top end, these 3 equal highs from Friday, Monday, and now Tuesday, if we could stay over that, if we do not revisit this range down below, I would certainly start putting my thinking cap on and saying, okay, is this the place where we can then go equal high? We have a daily higher low. Any breach up and over the weekly threat for the lower high brings in what? A higher high in the daily trend count if we get this pullback first. Now, the other thing that could take place here is that the market just blasts right through the overhead gap and finds acceptance above this level. It's really 550 is the weekly level that you'd want to use here. These previous lows, the Thursday high of last week. If we can get over that and just start accepting inside of this balance range right here, that's another really strong indication that it's possible a structural low starts to emerge over the course of time. Another thing that I'll point out just on the daily view while this is still top of mind is the strong response to the upside comes from almost the bottom end of the range. And so you would think it wouldn't be unreasonable for the market to stutter step at a known area of resistance or the gap close. And did either of those things take place? No, the news was so powerful, right? And the news being the pause, the 90-day pause on tariffs. They gave you the playbook on Monday. They instituted it on Wednesday. As of right now, the news was so strong. Remember, we had this conversation on Saturday. I think it's going to be a conversation that we continue to have. The market right now is trading on a news cycle. We call it the FU scale, right? Not literally FU, but we have max fear over here. We have complacency in the middle. Then we have little e. And then to make it funny, here's your big U for euphoria, right? The tariff fear when Donald Trump announced the massive reciprocal tariffs that were way larger than anybody ever thought they would be, put us almost at max fear. Any positive movement towards complacency, and if you've been tuning into the pre-market preps, you know we've been talking about this. Any improvements on the tariff front would start to cause a big rally in the upward direction. Once again, they gave you the playbook on Monday, and they instituted it here on Wednesday. So we've seen that. We're moving away from max fear. The next thing that would potentially cause max fear would be something from the labor market where, oh my goodness, there's going to be this huge unemployment recession. But if we think back to last Friday and the jobs numbers that we got, that's not even close to max fear. And as a matter of fact, as we'll get into the fundamentals, as the video wears on here, if tariffs are going to be reduced or put on pause, the new statement is that, okay, we're going to bring it down to about 10% across the board. That gives the Fed a little bit more wiggle room to maybe look through some of the inflation that they anticipated was going to be coming from tariffs, and they'll start using that T word again, T, of course, for transitory. So if the actual applied and realized tariffs do fall into this category, I think that the market, the worst is behind us, right, in terms of the max fear and the volatility to the downside. And then it becomes a matter of, okay, are we actually going to see a growth-style recession in the near term? And we'll start using some of the other soft data that the Fed typically collects. But back to the technicals, in terms of charting the S&P here, as you've probably been able to tell from my just excitement about this so far and just the way we've talked about it, higher lows will be a top priority over 523.75. Is it reasonable that we pull back after, once again, 11% up day? Absolutely. If we do pull back, great. Anything that supports here, awesome. Now we start having what? Let's take it down to the hourly time frame chart. It's a double bottom neckline retest, right? If this is the double bottom, this is certainly a soft higher low because maybe the hourly trend was more so neutral in here. It never really flipped. I wouldn't say that there was much of a trend change. This was a balance, right? Regardless, here's your Monday capitulation off of the open. Mom and pops call up over the weekend and say, sell this thing as soon as it opens up on Monday. That's the initial lower wick. And then beyond that, we never go back and revisit those lows. If the market was going to be in a more compromised position, shall we say, then this morning's consolidation probably should have broke down. Brigade bolted underneath 494 and then retested the equal low from the Monday session. That simply did not take place. Now, we have to give a little bit of credit to the sellers here because outside of this news announcement, things actually weren't looking that great. If you put yourself in the shoes of a buyer on Tuesday morning's open, which mind you was way up here, ideally what buyers should have done is produced a higher low over the top end of the Monday consolidation. And obviously that didn't take place. So this morning's open, as we were sideways in this channel down here, it actually was not that great of a position for buyers. And it's almost, I don't want to say it's a get out of jail free card that the tariffs were ultimately put on pause, but it starts to look a little bit more so that way, right? The threat would have been outside of a news announcement, another lower high, equal low, sets up the H pattern, sayonara, and then the Monday low is back on the table. So this has now afforded us a new opportunity to seek some sort of structural higher low over the 523.75. Been very clear about that. Any price acceptance over 550, so closing the gap overhead and getting some sort of acceptance over 550 inside the previous range from the weekly, that also starts to look pretty constructive in here. So the buyers have the gift right now, and the buyers need to materialize on this gift because if it falls apart, if the market comes back down underneath the top end of this range here at 523.75, let's play devil's advocate, now you've got two failures. You have failure number one, which was the buyers unable to produce the higher low over the Monday consolidation on Tuesday. Get out of jail free card one time, need to hold here. If not, kiss it goodbye, like easily coming back down into the equal low. So the contingency plan here is that if the market does not hold over 523.75, I put on my very open-minded hat and I say, okay, I'm willing to trade this market in both directions if we're under that level, and I'm not as committed to seeking some sort of higher low right here. Okay? That is the name of the game. That's what we're watching for. Those are the key levels. To the upside, we still have some concerns, right? We have both key moving averages, the 50 and the 200, up there in green and blue, respectively. Well, blue is 50, green is 200. We also have the do or die zone high, which is still in play. That could keep some sort of monthly lower high, on the table. But once again, remember the statement that bears might oftentimes sound smart, but who makes money? Definitely the bulls. The bulls make the money. The bears sound smart. We want to be very open-minded to a recovery rally here now that the worst is behind us in terms of tariff fear. I do want to come in here with the anchored VWAPs because they're just beautiful confluence with some of these key levels. What you'll notice is that this is at 550. So once again, a pullback is not unreasonable. Very, very reasonable thing that could happen to pull back and get that retest of 523.75. Over the short span of time, and we'll see this based on the market profile in just a moment, volume actually did transact quite a bit up here. So these anchored volume-weighted average anchored prices, anchored VWAPs, will be pulled higher to sooner rather than later provide confluence at the 523.75. That will be a top focus into the end of the week. If all morning session on Thursday we're consolidating and pulling back, we'll be watching to see if these pull higher. And once again, it's a great spot to start looking for a potential daily higher low to confirm whether or not the capitulation low is in. We talked about on the weekly chart, sellers failing the gap down on Monday. We talked about here on the hourly chart, it's a little bit more visible, right? This higher low in terms of the double bottom that's played out. And now we're talking about the opportunity for a higher low above the neckline to start suggesting the next structural development for the market in the upward direction. Underneath 523.75, and I would start to reevaluate the tone of what we're looking for here. If you want to try to play contrarian and try shorting this market up here, looking for the pullback to get there, there's nothing wrong with that as long as you can manage your risk. Likely what I would think is somewhere up against 550. Right? And that is what we have on the hourly time frame. Let's jump on over to the market internals because this helps us also confirm whether or not the capitulation low is in. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally speaking, today was one of the wackiest days I've seen, even outside of what happened into the afternoon. The morning session on the tick was brutal. This could not make up its mind, and you know this if you're in the chat, while we were trying to trade NVIDIA, right? It was like stuck at the lows, and then it was stuck at the high, all over the place. Ultimately, you can see that it did end up closing positive here, which I do like to confirm the upside. But beyond that, I mean, look at the volume flows. This is astronomical amounts of volume flowing into up stocks versus down stocks on the rally. Basically, everything across the exchange was higher on the session here. The advanced decline line confirms that as well. If we come into the market watch tab, and let's just go to visualize, let's go to index watch, and let's throw in here our good friend, the S&P 100. There you are. There you go. 101 advancing issues, 0 declining issues. So are we starting to get that counter move snapback with the correlation bit? Absolutely everything across the S&P. Let's just check the S&P 500 just for the sake of some giggles here. Yeah, 492 versus 9 out of the S&P 500. Incredible degrees of correlation to the upside, which would still indicate that we're somewhat in the throes of volatility. But all that suggests is that broadly speaking, this tariff relief, if you will, is moving the entire market, not just pockets of the market, not just specific sensitive sectors, but the entire market back in the upward direction. And that's really what we care about as we start thinking about a structural higher low forming over the neckline, which of course over here in our good friend, the ES futures, is going to be around 5,300, right? We'll be watching that closely. In terms of the index score intraday, nice print to the upside there, very strong into the settlement. This comes on the heels of, again, Tuesday. Let's focus on Tuesday because I have to give the sellers a little bit of credit where credit is due. On the Tuesday session, we actually opened, if I just flip this over here to our historic breadth ratio, what I want to point out about Tuesday was just the sort of disappointing flip-flop. Is this not going to auto-zoom on me? There we go. The disappointing flip-flop from the morning session, Tuesday on the gap. It wasn't a true gap, but opening higher in the range, right? Promptly faded to negative, very negative breadth into the afternoon. And this was bringing into question whether or not the capitulation gap was, the capitulation low, was going to hold. So to see such a strong recovery into the close of today's session, you can see these numbers are literally off the chart. We have to go way up here. We're talking about positive 50 on the breadth incredible thrust to the upside as this tariff relief is taking place. And once again, I think that broadly speaking, this helps build the case that we're open-minded here to a structural low. It's not just pockets of strength that are driving this higher. I'd be much more concerned if the market rallied and looked like this, and yet breadth was like in here, or maybe we saw like a +3 into the close, right? That would indicate, okay, there's pockets of strength, but broadly speaking, not everybody's happy about this new information, right? So that is the internals dashboard. Let's jump on over to our good friend, the market profile. And what I find most compelling about this, first of all, if you're not familiar, check out the video tutorial in the top right-hand corner. If you're not familiar with the market profile, then, you already saw the tutorial, but this is just incredible. The fact that the value area and point of control migrated higher with price, even though the time spent up here was, exceedingly less than what we had down here through this big H period rally, right? Just incredible. Like I'm saying, the fact that people want to commit volume up at these higher prices is a confirming indication, not a rejection indication. So what we can watch for here is now twofold. Number one, if we can stay over the neckline of this pattern, once again, if this pullback takes place to like 5,300 on the ES futures, we just talked about the 527 mark over on the SPY, right? If we could stay over that, then all of this value is content. There's no reason that these people should panic. Well, if we fail that level, right, this is where, okay, the thin structure retracement to the downside becomes incredibly attractive, and there's probably a decent short on a move underneath 5,300 to get into the singles. If you really want to be pinpoint precise here, it'd be 52.83. Underneath 52.83 unlocks these singles back down towards the bulk of the value down here around 5,100 flat. If you're looking for a level to use, that's the single print closure. You can clearly see very, very sparse, thin volume at price. So that is that. We have an extremely poor low at the bottom of today's session. We do have a decent excess high up here. I'm not calling for this to be repaired, but if the sequence ends up turning into this failure of 5,300, let's say we come down, look like this, I would say, okay, any lower highs that then come into the low of today's session, we should be going through. We should be going through if we were to get there. But once again, base case as of right now. Let's get back into the habit of using that maybe, the base case to outline what we're thinking about. Base case is this for higher, right? Show me that structural higher low on the daily time frame chart. Put all this madness behind us, and now I think we're in better shape for upside. Now, of course, with all of that being said, I think that it's time to maybe acknowledge that any headline that maybe reverses the decision that's been made today will be absolutely horrific for the market, and I really would expect the unwind underneath. Did I say 527 just a moment ago? I meant 523.75 if I did. Regardless, you've heard me say it enough. We've drawn this pathing enough off of the area. Any higher lows, or if the market gives a lockout rally over 550, we want to be very open-minded to upside. That way we're not left in the dust. If you want to reference the August 5th panic low, right, this is your capitulation gap down. It's actually very similar, if I'm being quite frank. We have a couple of follow-up sessions that are, mostly balanced back-to-back. And as the market goes, right, you don't want to start saying like, okay, no, there's a lower high that could happen here, or there's the lower high, equal high that happens here. You don't want to be overly attached to needing to see the higher low pullback, right? This lockout can certainly take place if that's it. If that's the capitulation low and we're all in the clear now on the tariff front, negotiations are taking place, 90-day pause, we're bringing these things from like 34% down to 10%, maybe not on China, but broadly speaking on the other countries, this is top of mind. Either this, great, or over 550, we will promptly change our tone and we'll start looking for further upside, right? Once again, bears sound smart, bulls make money. Let's stay on the making money side of the equation. Let's move on over to the QQQ NASDAQ 100. If we take a look at we can go monthly real quick just for the sake of being congruent. Where was the higher low? We're not going to clear up the levels, but there it is, and there is the lower wick of the monthly bar. We're already in the previous month's bar, same concept as the S&P, and all of this taking place where? Over the monthly 50 SMA. Let's take a look at the weekly time frame chart. Another failure on the gap down. Sellers were unable to continue to extend the losses in the downward direction. We've already closed as of today's Wednesday session over the opening print of the previous week. Once again, doesn't mean that a weekly lower high can't form here. It would be a decent spot in terms of structure, but I would reinforce the point. Let's not overstay our welcome on the bear side, especially if we're trading the indices, the indices. They go up 80% of the time, right? We'll deal with secular stagnation when the time is right. If we just go out to a big monthly time frame chart, this is the period between basically the dot-com bubble bursting and the GFC, Great Financial Crisis. Oh, now I'm just wasting your time. I don't want to waste your time. Let's quickly look. Come on. This is secular stagnation here. this is where the bull market resumes, and it's even cleaner in the S&P 500 if I'm being honest, right? Returns were not there. Unless you were consistently dollar cost averaging into the lows, which is a fine strategy, then there's nothing to do in this box. There's really nothing impressive in this in terms of generating a total return out of the market, right? Maybe you collect some dividends, but that's not really what we're after. So anyhow, all good back on the QQQ analysis. Let's get to the daily time frame chart here. Let's quickly take a look. Moving fast. There's a lot going on in the market. It's kind of exciting times. It's wild times, but it's exciting times. Let's try to keep a level head, though. Although we're moving fast and, again, markets are exciting here, I think so far it's been a logical approach. And if you agree, let me know down below in the comments section if you're like, no, you're insane, dude. This is going to crash and go even lower than the last lowest low. I'd also love to hear from you. I'd love to hear a differing opinion, and we can weigh the data points and see what happens. QQQ daily, once again, at the inflection point for a possible weekly lower high. This would be the same thing as that 550 threat we just talked about on the S&P 500. It's 465.85 on the QQQ. If we get pullbacks, once again, your key area of potential new support is over 441. So all of the concepts remain the same as the S&P 500, and those are your two key levels. 441, line in the sand, pullback to get there is fine. Structural high or low on the daily time frame chart, great. Or some sort of continuation into the weekly range up here negates any need for sort of a pullback, and the acceptance higher starts the lockout rally. Would really start thinking about that 492.50, the top end of the weekly balance, right? That's what we have on the daily. Let's get a little bit more granular on the hourly time frame chart. Once again, here is your double bottom. Here's your neckline. This is why we're interested in potential pullbacks above, because it sets a higher low on the daily chart as well as the 1 hour in terms of reversing, right? We have lows, higher lows. This would easily act as a new higher low, especially after producing a new higher high in the hourly trend count. So all set from that point of view. If the market were to fail this entire structure, as we've been saying, and again, we'll be open-minded to it when and if it happens, but if this were to take place, midpoint of the range becomes the first target, 429, top end of the balance from the Monday morning or afternoon session, really. And then beyond that, I would be seeking an equal, if not lower low, underneath the previous all-time high from 2021 at 404.50. Right? This is the failure contingency, but base case. Again, to get back into the habit of the base case. Base case says either this, back to an equal high, or straight up acceptance over 465.85. We have to take it at face value, start looking for some further upside. Will it turn into a bull trap? Yet to be seen, but so far the data points, let's even bring it on over. Well, firstly, let's slow down here a second. Let's go intraday anchored VWAPs, right? Maybe the pullback is reasonable because we do have, this is the all-time high anchored VWAP, FYI. These are the ones coming up off the lows. Once again, I think it's reasonable that with the volume commitment up here, these could easily start coinciding with 441 before the end of the week. These could get here like midday on Thursday and be there early, bright and early for Friday morning's open. So very interested in these things. Another thing which back of my mind is starting to creep up because we know that we have a news event tomorrow morning, CPI. CPI will be interesting. If CPI comes in hotter than the expectation, you're going to want to see the pullback sort of situation. That would be my first take at least, is let's get for a pullback down to that 441. If CPI beats expectations, oh boy. I think this market is head over heels, off to the moon, and just ecstatic about dodging all of these bullets and all of these black swan things that everybody thought was going to be the end of the world, which to some degree were. I mean, off the all-time high, we certainly pulled back a meaningful amount, down over 15% across the indices is nothing to shake a stick at here. So that is what we've got out of the NASDAQ. Those are the levels. You could also maybe come in with a fib off the low, the move up to the high of the move, and see where we're at here. Holding over this level would be a slight undercut of the 38.2, but it would certainly be over the 61.8, which is always a line in the sand. And if we actually bring this to this low, I'm sure it's actually a little bit better in terms of confluence. There you have it. From the capitulation low back to the neckline of the double bottom gives you your 38.2. And just for the sake of being congruent, let's also do that in the S&P 500. Not that we're, again, you could use both. I would encourage you to use both. But generally, there's your 38.2. And if we come in from the higher low up to the high, it's actually even close as well. There's a 38.2 there as well. So all set on the fib analysis. Let's get on over to our NASDAQ internals and see what's going on from this point. Rinse and repeat. I'm not going to bend your ear about the strength of the internals. They speak for themselves, and they speak to correlation in the upward direction, which, yes, is a hallmark sign of volatility. However, it's not pockets of strength. It's a broad-based rally. Everything participated in the upward direction. You could, if you wanted to take the stance of volatility, that's fine. But once again, even if there is a pullback, we are now looking for a structural higher low now that the pattern has resolved. This pattern has resolved. The double bottom over the neckline. In this case, out of the NQ futures, we're talking about something like the 18,365 level, right? All right, let's move on over to our market profile for the NQ. Any big discrepancies out of the NQ? It looks like the value did not shift higher into the overhead session. There's still a decent distribution of volume up here, but not nearly as much as the ES. I think that this makes sense, the ES being a little bit more broad than the NASDAQ 100. If we do something that looks like this, you are getting that 18.4, 18.365 as the key single print hold. So as long as we're over that, that makes sense that we would want to see buyers remain in control, looking for upside. If we do fall underneath, thin structure retracement, once again, it's about the same analysis as the S&P with your H period single prints here and the very poor low at the bottom of today's session. Let's jump back on over to the platform here and let's finish up the indices with our good friend, the Rusty Russell. What's going on with the rut? And let's do what we do best, maybe from the monthly top down. I like the fact that it's supporting off the bottom end of the monthly range. However, this is where we say, not everything is rainbows and butterflies. Certainly a lower high possibility, even from the monthly perspective, just not being over the monthly 50 and also still being underneath. This is just 200. Right, 200, the nice round number out of IWM, is the top end of the monthly range that could easily still offer a monthly lower high after producing monthly equal lows. Or you could even argue from here to here, it's a monthly lower low. So not thrilled about small caps being a little bit more sensitive to everything that's going on from an economic perspective. It'd be much more convincing for the market to truly be on its way if small caps could get up and over 200. So I'll be watching that very closely over the coming weeks. That's your higher time frame look, at least. On the weekly, it still looks good in terms of the capitulation low. It was a gap down, small extension on Monday, of course, but from there, back inside of the previous week's range. That's helpful. Once again, this is still a threat weekly and monthly. That's that 200 figure. Let's drop it on down to a daily time frame chart, see what else we can learn. And once again, this should be like jumping off the page at you. It's not quite as strong as the S&P and the NASDAQ. Note that Monday's high was already a gap close to the Thursday low of last week, and we've just closed right at that level. Now, I'm not going to sit here and say that the chart is like abysmal and, oh my God, it's the worst thing in the world. It's certainly constructive in the upward direction, and it maybe offers an opportunity for a loose kind of higher low in here, and you can see that structure more clearly on the hourly chart, actually. If I do something that looks like this, notice you have Friday's high, Monday's consolidation, and honestly, Tuesday intraday, the opening wick lower and then this lower high rejection, there was a decent little respect for 182.50. So if we were to pull back to that, needs to hold as a higher low on the hourly time frame chart. You're not going to be able to accomplish a daily higher low at that point because of the way that this structure has built out. Another thing to indicate here and talk about is just the fact that Monday's low, Tuesday's low, and then today's low, it's all so equal here at 170, 170. That's just the improper end of the auction. That's like one of the first things, right, that you learn market profile wise in terms of all these equal lows stacking. That's not how an auction should end. It should go out on a bang, not a whimper. We sort of saw the bang in the S&P and the NASDAQ where we had longer lower wicks on the Monday session, and we snapped back hard in the upside, and we never revisited those Monday lows. But this doesn't really have that compelling look. So I would treat the Russell as much more of a balance range in here, and I would really get more excited about this if consolidation starts looking like this, building a block in the upward direction, and then ultimately if we could get up and over that 200 figure. So the Russell is maybe a back pocket bearish data point for anyone who's like, nope, market's still going to hell in a handbasket. You would want to lean into the Russell data point just being underneath the 200 figure in here. Let's go back to the hourly just so we could take a look at the intraday anchored view apps. You will be getting confluence near that 182.50 zone, so that's making sense if a pullback does happen. You know, this is certainly something that's reasonable, but to be constructive on the higher time frames, you'd really want to see it here and then here over the all-time high anchored view app from up at the top, right? And that's over your monthly key level, which we've labeled 198, technically 200. You could, let's not split hairs on that higher time frame monthly view. So all set from that perspective. We'll quickly come in with the fibs just to be congruent from the low up to the high. 38.2 is above the confluence zone, 61.8 below. 50% retracement would be right on the money at 182.50. So we'll watch for that, but it's not a make or break. Let's jump into our Russell side internals and see what's happening from this perspective. Big volume inflows to the Russell. You could see decent correlation up here towards the highs on the advanced decliner. The cumulative build, though, not able to close positive out of the rut, where we did get that in the S&P and the NASDAQ side of things. So not shocking, considering everything that we just walked through in terms of the relative weakness that's here relative to the other indices. Let's jump on over to the rut on the profile. And this one did accept value higher, point of control higher. Single prints H period, yes, it is in play. This would be, where would we be here relative to this? We want to, where am I going? I want to look at the futures. My apologies, back and forth a little bit. I want to look at this level in here. What would that be? The level we want to see hold, if there is going to be a higher low, is 1846.70. 1846.70 is about half back and midway through the singles, something like Friday's high, Monday's consolidation value, and then Tuesday there was that intraday respect off of the opening lower wick and then the subsequent lower high underneath. Anyways, 50% retracement puts you sort of inside of the single prints. I might be a little cautious of trying to buy that on the small caps, just noting that I would think a retest of this area, if we were to get there, you're really asking for a full single print retracement, which would get closer to 1800. So if you're looking for a contrarian stance, if you're looking for the market to be bearish, if you want to short the S&P towards the highs, I would start thinking about, all right, if the S&Ps can hold the highs, but the rut comes in and starts looking like this, right? That's probably a situation where Russell starts doing this, where the S&P is holding near the highs, short the S&P on the premise that the Russell is acting as your leading indicator that we're going to close the singles, right? It's just an idea and one possible permutation of how it could play out. Let's jump back on over to the platform here and let's take a look at our sector performance. Everything is green straight across the board. If we take a look at the weekly performance, it's going to be all over the place because of the way that this script is, it doesn't like big numbers over a two handle. You get 21.5% out of semiconductors today. You get 16.5% out of tech. Then you have discretionary here, 11.2% communications. These are all heavyweight risk on components for the market. So even in the broad-based rally, again, everything rallied, the risk on components are rallying the most. It's not like they lagged and we saw outperformance from things like healthcare, consumer staples, or utilities. If that was the case, I would not trust this rally as far as I could throw it. So another feather in the cap for anyone who's thinking, okay, that was it, the market's going to be more constructive going forward, the sector posture is correct to indicate that. If we start looking through these structural charts, though, there are some concerns for sure. It's just not like, you flip a switch and everything's fine and dandy. It's just some work that needs to be done here. Energy is still underneath the sine wave balance overhead. So again, a threat for a lower high is certainly possible over here. If this rejects and comes back down, it's possible that the growth scare in terms of a recession is still on the table. If we look at crude, let's take a look if crude would load here. We know that this big breakdown underneath the cliff has been pretty bearish for the forecasts on Q1 GDP. Lower high is still a possibility, and that's from a technical perspective underneath like 65. So we'll watch out for that. And again, you're not out of the woods on all of these charts, but there is broad-based improvements, at least off the lows. Materials, still a threat for a lower high here. Close the gap overhead and then a lower high. This is not as clean as getting some sort of move over the Friday high, as well as just generally up and over the balance range that's sort of formed here. You can see it's more so an equal high out of materials. The saving grace, the silver lining, it's the lightest weight sector for the S&P, so it's not going to make or break anything. Healthcare, certainly a nice rally in the upward direction. It's a D for defensive sector, but it is the fourth heaviest weight sector now, unless it flipped back to the third, which I don't think it did, but it maybe has. Regardless, it's top four. I like that it's over 137. If it could find some support over the previous pivot low, it might help, but I wouldn't want to see this lead the charge in the upward direction, and it's certainly not. It's, air quotes, only up 5.35% on the week relative to semiconductors, 21.5%. Let's move on over to consumer staples. Same commentary. I'd love it if it found a structural higher low over 78.2. I don't want it leading the charge to the upside and blasting off the new all-time highs. That would sort of be a more defensive look if there's major outperformance here and everything else was lagging, but it's just not the case. Only, again, air quotes, 3.5% on the week so far. So you move into utilities, it's the same conversation. Here's your balance range possible for a lower high. It's defensive. If it sets the higher low, then great, but I'm also not overly concerned if it just rolls over and goes sideways in here. Let's get into the big dogs, semiconductors. Step in the right direction, and what's more important about semis that we should talk about once again is relative to the Friday, Monday, Tuesday ranges, we are well above those highs. Everything else that we've just looked at for the most part was clustered more so in a balance that looked like this, right? And today's close was here on those balances. Note that out of semiconductors, yes, this is a massive test of a previous set of lows, and yes, it's a fine place for a lower high, but this higher low is much more constructive out of semiconductors relative to what we just saw through some of the defensive and lighter weight sectors we were just evaluating, right? So 195.15 top of mind. Let's jump on into real estate. Big recovery effort happening here after rates really moved all over the place. And we'll get into rates more specifically in a moment. But lightweight sector, yes, lower high opportunities for sure. Higher low would certainly start to change my tone a little bit. We'll watch this one, but it's not going to make or break. Let's move into the XLK technology sector. This, like semiconductors, it's the same conversation, right? You have these equal highs, which now have the opportunity to act as double bottom neckline on like the hourly charts. It's a rinse and repeat of the QQQ analysis, really. If we're over the neckline for a higher low, great. I think we want to start being constructive out of the tech sector instead of saying, okay, it's doom and gloom and this market's going to fail and go to zero, right? Show me this, and then like over time, like, don't forget, the market doesn't have to do this straight to the all-time high. It can do this, and it can spend some time here, and it can break to the upside, then it can fake out a little bit, but as long as this structural higher low happens here, that starts to give us a place where we can manage risk against and change our base case to being more constructive on the market rather than, oh my goodness, the trend is down, it's Armageddon, oh God, like markets are going to zero, right? We're looking to spot that turn. Let's take a look at the discretionary side of things. This is even more impressive over the set of lows. I mean, how could you not look at this and say, my goodness, that's bullish, right? It would have been gap fill reversal. It would have been a rejection of these highs. It would have been a rejection off of this. It's just not happening, right? There's no upper wick on this bar. 192.75 would be the picture-perfect consolidation. This is sort of the situation in the S&P 500 where we're getting acceptance over 550, and you just get a lockout rally to the upside, right? That's a possibility here. If it pulls back, your key watch is off the equal highs at 187.75. Moving along to communications. Still, same concept. Here is your bottom end that offers the threat of a lower high. It's absolutely there. We're acknowledging the threats of lower highs, but what's the key take? Right? If we set the higher low, this is where we're constructive. 90.85 out of your XLC, heavier weight-ish, medium weight, risk on style sector. Your Google is in there, right? Industrials. What's going on with industrials? This too, over the top end of the multi-day balance down on the lows from the capitulation style move. Yes, the lower high threat is there, but 122.50, if you're over that, come on. We're looking for that structural low to build out. We'll be watching very, very closely. Anybody who, and again, I think, you can probably hear it in my voice. I want to get back to being the perma bull of YouTube. That's just who I am. You guys know that. It's not unreasonable that the market pulls back. If you want to structure a short, and flip in the S&P 500 here. It doesn't have to be the XLI. If you want to take a short and take a stab at the possibility of a weekly lower high, then be my guest. But I just don't want to get caught on the wrong side of a face-ripping rally that locks out to the upside. And oh my goodness, we're trending in the upward direction again, right? It's not often, like it's not a regular thing that your market falls into a big 50% correction every other year, right? It just doesn't happen. Everybody's scared of the great financial crisis, and maybe rightfully so, but that's not the norm for the market, right? Let's move along for the XLF. Big improvement here, breaking out of the balance. One thing that I would like to see is this hold over 47.10. The only iffy factor on financials, of course, is earnings on Friday. You have JP Morgan, you have Wells Fargo, you have Morgan Stanley, I believe is also wrapped in there, Bank New York, and there's another one. We'll take a look at the earnings calendar in just a moment. TLT, this has been a little crazy all over the place here where yields actually were dropping like a rock, right? Yields are inverse to the bond price, and dropping like a rock and then shooting higher like a shooting star. So all over the place on the tariff uncertainty. And one of the things we've been referencing over the last day or so is the MOVE index, and that's MOVE GIF, as a matter of fact. But what I would cite out of MOVE is that we're in the zone. Let me go max available here. It's not a very long chart, so it's just fine. Don't you worry about a thing. If we do this, right? This is typically the place where the MOVE index gets frothy. And MOVE, by the way, just in case I didn't say it, I'm losing track of what I haven't said. MOVE index is the volatility index of bonds. Think about it like the VIX, but for the bond market, right? So historically, when the VIX pops, right, everybody's like, okay, when's the VIX going to crash back down and confirm that we're out of the woods? It's the same thing here with the MOVE index. Notice this, notice this, notice this, notice this, notice this. This outlier, if anybody knows what that is, we went through the exercise this morning, is the SVB, Silicon Valley Bank explosion, when we found they were insolvent, basically, right? So with that, It certainly seems as though this is an appropriate place for bond volatility to maybe slow down a hair. And if that's the case, and we see this revert to the mean, basically, that would be more of a bullish data point. That would support the thesis that the capitulation low ultimately is in. So far through everything we've looked at, I would start thinking about if these higher lows are produced, it's looking pretty solid for a possible turnaround story here out of the S&P 500. Let's jump on over to our sector ratios and just take a look at the performance on today's session. So an uptick out of the tech sector relative to the S&P, that strikes me as a first step in terms of risk on, but let's not be blindsided and I don't want to totally have the drunken bull goggles on. We're still in a downtrend here, so we'll acknowledge that. It's still possible for a lower high. XLF pulling back doesn't really strike me as being all that great. XLV, though, this is defensive, so it's a good thing that the XLV underperformed something like the XLK moving higher here. XLY sort of flat in here, but well off the lows. I like that. It just would signal to me, right, if I hover my cursor, this is basically the gap down and this is the big panic. You never really saw that big downdraft out of the XLY for risk off. If you look at communications, it's still sort of sideways in this grinding range to the upside. Industrials, sideways to slightly lower to the 50. What I do like is the fact that the XLP underperformed, the XLU underperformed. This starts to feel a little bit less like, okay, risk off is the current environment that we're in. And we can reinforce that as well with some specialized ratios here. Take a look at this thing. XLK SHY, you're getting outperformance there. You're getting it here out of tech versus the utility sector. You're seeing it here, discretionary versus staples. You're seeing it here, semiconductors versus healthcare. So some, what we would call just green shoots. You're getting green shoots across the market. Even ARKK, small outperformance, certainly still in a downtrend. And we're going to give this one the respect it deserves. That's no beauty of a chart over here. But for today's session, the risk on assets certainly outperformed, which is noteworthy. And that's what I think I'm trying to drive home through this exploration. Let's jump into the dollar, which honestly didn't do much. I mean, we're seeing some volatility, don't get me wrong, up, down, sideways, all over the place, but still in this box. I think that this morning we saw news, right, that money is flowing into the German Bund out of U.S. Treasuries, perhaps. So we'll continue to monitor that. The auctions seem to go just fine during the 101 timeframe. That was sort of as the tariff news was being announced as well, so hard to say exactly what the indication would have been there. Gold ratio to the S&P pulling back, so are defensive assets outperforming? The answer is no. Even though gold had an up day, right? It's just a matter of the S&P having a larger up day. So the ratio moving lower is a check mark for the risk on bulls looking for equities to come back and outperform. In the spirit of that, let's jump on over to the TLT ratio to the S&P. Again, an up day here is fine, but it's an even larger up day in the S&P. Once again, this is a risk on indication for our bulls here. In the spirit of just going through them all at the same time, let's go credit spreads collapsing to the downside. This is a sign that perhaps the capitulation is in the rearview mirror. Right? These exploded earlier on in the week. The fact that they're falling off of a cliff now to the downside, we want to see that persist. We don't want to get complacent here and say like, oh no, there's no opportunity for a higher low. There is, but generally speaking, if this can come back down to the 50, if this can subside, it would seem to suggest that the volatility is in the rearview mirror. The capitulation low is in the rearview mirror, and we're watching very closely for the Brigade Bolt higher low over 5,300 in the futures. What was it? 523 was it over here in the Spider's Cash? Where are you? 523.75. I want to make sure we get all the numbers right. I'm going to drill that into my brain. So that's the credit spreads market. Let's take a look at the bonds relative to themselves. Small upticks here, just meaning that the lighter end of the curve is doing a little bit of the heavier lifting, and the longer end of the curve is taking a breather here, which is good, right? That means that Jerome Powell is going to have to do a little bit less work, right? The market's not relying on the longer end to adjust for these inflation expectations. What did we skip? We skipped the... Speaking of Powell, I guess we'll just take it on over to the inverted ZT, the 2-year. Small move in the upward direction as we're thinking that the Fed is going to be less concerned about inflation and a bit softer and not have to deal with the stagflation environment, which is the worst for everybody, right? So this little uptick here is like, okay, maybe the Fed won't have to bail us out of a recession as badly. Let's jump on over to the Fed Watch tool, and what we'll see over here, if we go to the probabilities tab, is we're actually back to pricing in strong odds, strong odds, 76.1% of a pause for the next meeting. Just this morning, it was decent odds, and I think, if I'm remembering correctly, it was over 60% for a cut. So we're still looking at 1, 2, 3, and then 4 cuts here into the end of 2025. So the market's still a little on edge about the growth story here and possibility of Fed intervention, but much less than what we were dealing with in the ahead of the tariff announcement, right? And one of the ways you could think of this is, and you can see it here in the meeting minutes. I've highlighted this. This is the FOMC meeting minutes that came out today at the 2 o'clock time frame. Several participants noted that the announcement or planned tariff increases were larger and broader than many of their business contacts had expected. You can go through and you can read this entire thing, but basically, right, the inflationary effects of tariffs might be muted now that we're going back down to a 10% base rather than some of these extremely high levels that were firstly suggested on Wednesday of last week, when the classic, that thing's going to get a name, the Trump tariff table or something like that. It's going to go down in history. 30%, 40%, 60% tariff on this country, that country, countries we hardly do any trade with, right? Which is just insane. And go back, watch the video, right? I said, go quote me, right? Everybody said, no, what are you talking about? You're so stupid, man. These tariffs, it's time for us, the U.S., to get their share. If you thought a 34% tariff was appropriate, I mean, you're just living on another planet, right? Go back, watch the video. I said that. I didn't think they had any staying power. It's not about being right. It's about making money ultimately. So, whatever. Let's go back to the earnings not the earnings calendar, but the Fed all over the place. I'm too fired up with this market. We've got the calendar for the economic data. Here we go. We have CPI, inflation numbers coming out tomorrow morning. They are scheduled to come in hot on the month over month at a 0.3. Remember, you can't sustain that. Otherwise, annualized, you're well above the Fed's target of 2%. Obviously, the year-over-year headline number is scheduled to come in at a 2.5, though. This is where we want to be watching. What's going on with the trend of the year-over-year, right? So far, this was starting to become concerning. The last month's print came lower. That was a slight bit of relief. If we come lower again, that would be a stronger sign for the Fed that they may not have to sort of bail us out of this massive stagflationary environment. Jobless claims will be interesting at the same exact time. Remember, we will have coffee and donuts. I'm paying the barista overtime tomorrow. Come on out to the show. Hang out with us. 8 o'clock Eastern time. We will kick off the pre-market prep. A lot of Fed speak tomorrow as well. We'll see how that goes. 30-year bond auction at the 1 o'clock time frame, and PPI, consumer sentiment, inflation expectations on the Friday session. We'll do it again, coffee and donuts, 8:30 for the PPI inflation prints. And that'll give the market a decent grasp as to what the PCE should look like into the end of the month, or as the reporter from Powell's interview the other day said, not the PCE, but the CPE. Anyways, let's take a look at when this announcement took place. Today, 1:18 p.m. over on Truth Social, and this I think was aligned with a press release from who's the woman who speaks at the, I'm going to blank on her name, but you guys know who I'm talking about. If we take a look, we're retaliating again against China, raising the tariffs to 125%, effective immediately. So China is still a question mark here. Let's just say China is a question mark as we move forward. But aside from that, right, this is what the market likes. 75 countries have called and are looking for negotiations, right? Negotiations was what we talked about in the very beginning. If you go way back to when the election was taking place, we talked about tariffs being a negotiation tactic. Not that we're tariff experts. Don't want to brand myself as a tariff expert, but when you're talking about levels this extreme, it's to get people to show up. I mean, you're destroying global trade if you're intending on holding those forever. Anyways, not an expert. That's just my little logical brain thinking out loud. And then you see here, I've authorized a 90-day pause, and I've substantially lowered reciprocal tariffs during this period to 10%, also effective immediately. So that's what the market liked. That's why it rallied. The only unknown here is how we're going to resolve the China issue, because as we've seen, China retaliated was it this morning or yesterday morning? I'm losing track of the timetable of tariffs, but they were like, no, we're going to slap 84% tariffs back on you. So it's all over the place out there. But aside from China, I think that we've seen some decent progress here. And this, just to give you, filling in the details for our human brain, right? This is why. This is the why behind the market rally. Let's take a look at the earnings calendar. We heard from Delta the other day, which wasn't really a great report. And then what we're mostly concerned about was JP Morgan. The missing number was BlackRock, of all companies. Remember, I was struggling to pull that last one. But these are the banks that we care about tomorrow. Primarily JP Morgan and what Jamie Dimon, we call him Jamie Dimon. We're good pals. we can get away with it. We'll see what he has to say for us in the earnings call and if he's citing any things. What I find very interesting, perhaps, is whether or not Jamie Dimon starts to talk his own book, very similar to the Bill Ackman style lashing out we've seen on X, which has just been crazy. And then you're getting the brown nosing right now, which is just that, oh my God, this is a brilliant strategy by the president. Thank you on behalf of all Americans, right? From Bill Ackman. It's like, all right, dude, settle down. We get it. You didn't get your margin call and you can live to trade another day. You didn't go insolvent. Like, kudos. Let's get back over to the platform. Let's take a look at what's happening over here. Let's jump on over to high yield junk bonds. You can see that they're confirming sort of the information over the neckline of the double bottom, all set from that point of view. We would just want to make sure that this continues to move in lockstep with equities down below. If we look at LQD, this was massively divergent not too long ago, just not really breaking down as aggressively. It did end up moving lower, but not nearly as much. Like what you'll notice just on a relative basis, here to here is hardly anything versus here to here in the S&P equities market was over 800 points. Right, so a little bit better out of LQD, and that's the corporate grade side of things instead of junk. So that's worth noting. Let's move on over to Bitcoin. Bitcoin did liquidate into the retest zone up around the 71.5s mark. If you take a look, this was right. It was like, oh, this is kind of interesting. It's holding in high and tight here. It came in and is now slightly higher. This is a weekly bar, FYI. So the fact that this risk asset is holding up here would be another confirming indication. If this could flip positive out of the Sailor Shift tool, that'd be another even better positive indication that, okay, it's looking more like a risk-on rotation for equities down below there. Let's move on into total breadth. This is where we could still use some improvement. I am liking what I'm seeing at the exchange level from the NYSE NASDAQ internals, right? But it would be even better if we saw some stronger upticks here out of the SPX A200R. Can we get the... I'm just curious to see actually what the SPX... Do we need the dollar sign? SPX... Do we have the 20? SPX 20R? Oh, SPX A20R? No, we don't. I want to see the number of stocks trading over the 20 SMA. We could probably find that trading view over here. And let's just jump into the super charts real quick. SPX A20. Can we get SPX? Is it a dollar sign over here too? SPX A? No. SPX stocks over above. There we go. S5. Okay. Here it is. S5. Okay. And then we want to go to a 1-day chart is fine. And let's just quickly make this a line chart. Thank you guys for sticking with me on this one, but I do want to see the improvement if there is any to talk about. Yeah, what we're seeing here is decent improvement. So this is stocks in the S&P 500 trading over their 20 SMA. I think that what you're seeing is just a massively oversold move to the upside off the bottom here. I mean, you're literally at almost nothing in the S&P 500. Less than 5% of stocks at the low here were trading over their 20 SMA. So a little bit of a snapback rally, but not close to the 50% mark, which would be up here just as a reference point. Let's get back over to the platform, and you can see new highs versus lows, small uptick, so improvements, but not to the degree where breadth has totally confirmed a breadth thrust. And oh my goodness, like it's time to rock and roll. We're going back to all-time highs. This would be the next domino that needs to drop to confirm the capitulation low is in, and we are looking for a structural recovery effort to the upside. You want to see broad-based continuation. Another way to watch for this is over in the RSP. If you take a look here, what we would want to see is mostly similar to the S&P, where we can hold this and see improvements. Generally, you would just not want to see a rejection up against these lows. If we were to pop in a level here, it would be these sets of lows around, let's just call that 172 flat for the sake of round numbers. And we'll just continuously check in on this week to week as we progress, possibly in the upward direction. And if we do pull back, trying to seek that higher low over the double bottom neckline, which would be closer to 161. 161 if you want to track this over in the RSP to ensure that breadth is following through to the upside as well, trying to build a confirming data point. QQQE would be a very similar concept where you're looking for acceptance over about 86, let's call it for round numbers sake. Let's see if we can't pop that in there as a rough level to watch. If we're above it, great. And then if we pull back, you would probably want to see something like 81.25. For the sake of round numbers, I'm willing to give that one a couple pennies in there. Perfect. That's that. Let's jump on into our volatility index and see that the VIX is coming back down under 40. So have we hit the capitulation spike? It's certainly possible. This is the August 5th yen carry trade explosion. If we take a look at the VVIX, volatility of volatility, also coming down. You can see in the one-day VIX that we're still elevated though, and this is one of my concerns. This is something that I would want to see continue to improve. If the market is going to put in a capitulation low, if all is going to be over, if everything's going to be fine and dandy, and oh my God, this is going to be so funny to look back at and laugh at, then you need to see the one-day VIX drop all the way. I'm talking all the way to 745. I don't know that that's going to happen over the span of the next little bit, but that is the next major indication out of volatility. I would also want to see these flip back into contango over on the VIX curve here. So we can watch out for that. These would generally need to move back up towards the zero line and over the zero line for follow through in the upward direction. Let's get back on over to the charts here. Let's take a look through some of the core list of companies, and then I have 2 trade ideas and I'll send you on your way. Let's jump into NVDA and see what's going on from this perspective. As we're taking a look, let's not forget that we are still technically in a downtrend here. However, we don't want to be silly. We don't want to overstay our welcome on the short side. Actually, let me pause for a second. I would say it's more possible that individual companies, of course, individual equities, can sustain stronger downtrends. The broad market itself, because it's obviously going to rotate and it's cap weighted, you're going to see differences in terms of what's driving the actual trade, and I'd be less inclined to say that the S&P is going to sustain the longer-term downtrend, right? So things can fall in and out of favor, that's fine, but the individual equity is probably where you give it a little bit more of an opportunity to change trend more aggressively to the downside. So downside trend still intact. If there was going to be a place for a lower high, it should have been here, right? 104.75. That did not happen, and instead you can see that we've closed back over this, or at this level even, if you'd like. So walking forward, anything that supports over 104.75 sets the high or low, and now this starts to turn into trend reversal over the trend line, and we're rocking and rolling to the upside, possibly looking for the weekly 129 zone. So as we walk forward into the end of this week, Thursday and Friday, if NVIDIA wants to play nice, and if NVIDIA wants to offer a pullback, high and tight consolidation over 110.85, great. Brigade bolts over 114. Underneath 110.85, pullbacks towards the bottom end of the zone. I would watch 107.15, 104.75. When we get here on the hourly, something that looks like this. If we fail, 104.75, great. It was nice knowing you. And we're just right back into the downtrend. Looking for shorts here. Equal low becomes the target, down at 88.15. Moving along to Softy. Big improvements to the upside. Let's go daily time frame chart first. Again, think about overhead supply. Think of that concept. If sellers were going to really step it up here, it should have been a rejection up against 377.25. Didn't take place. So now, walking forward, you get consolidation here that breaks out to retest the weekly overhead supply level, 403.25. Let's go to the weekly chart so you can see that. That level comes from this consolidation, so that would be your target to the upside. If we go back to the daily, and if we're thinking about a deeper pullback, right, so anything that's more than just this and then a Brigade bolt over, this pullback needs to hold 377.25, and then underneath, right, this lower high here starts to contaminate the action a little bit. I would start thinking back again about downside under 377.25 into the weekly cliff at Microsoft 365, which is just oh so ironic, and we'll continue to point that one out. Let's jump on into AAPL and see what's happening with our good friend Apple. Tim Cook is not cooked anymore. Big rebound. However, I would say that this chart still exhibits relative weakness compared to other names we've seen so far. This is all overhead supply. This is still a lower high threat. You're not all the way over, in a clean sense, the high of the Friday session here. If we take a look at this, maybe you could call this a double bottom. Notice that it's a lower low double bottom. It's not a higher low double bottom like the broad market. If you were going to see a neckline retest, that would have to be over 189.25, keeps the buyers happy. But there's going to be places to look short if the broad market starts crumbling overnight and oh my goodness, we're walking back the tariff announcement. And you know what? Actually, let's escalate things with China. I think I heard a clip from Kevin O'Leary that was saying that he wants and is a proponent for 400% tariffs on China. If we take the Kevin O'Leary route, then perhaps we see something that looks like this. Apple would be the first place I look for one of those shorts to unfold because of its relative weakness. Let's move along to Amazon. Daily time frame chart. Here is the consolidation range. Here's the overhead supply. You're caught between a rock and a hard place. I would watch for this equal high reattempt and then going through. If we fail 184, choppy balancy in the range. If you want to try to, again, like for the S&P 500, if you want to try to catch this pullback for risk reward like that, you can be my guest, but I would try to maintain the more optimistic stance here. If the tariff news is in the rearview mirror, if we're out of the woods from that perspective, this is what you're looking for. 184 is that key level. Here it is on the hourly time frame chart. Here's your consolidation. You break out of the range, you retest the top end of the range. Classic Brigade bolt. Classic Brigade bolt straight back, excuse me, in the upward direction. If it's going to fail, let it fail into the range. I would prefer to honestly start trading it short under 171 to get through. Whoa, that's not what we wanted. I would prefer to trade it short under 171 to trade this thin structure retracement from the Monday gap down. Let's jump over to Google. We'll just keep these things on the hourly chart perhaps. I'll leave them zoomed out at first so we can see the overall structure. You can see the overhead supply here. And if we do this, we actually closed over 157, this prior low. It's also acting as resistance back over here. Double bottom neckline, 151.75. To me, primary structure, just like everything else. This is fine. You could try to take that short. And I honestly would look for that out of something like Google because of the close above. If we're below, it becomes a little harder to pick off the short entry, right? If you're above, you just look for a failure pattern, a Brigade bolt lower high on a 15-minute chart under 157, and now we can manage risk against that for the pullback. So Google plays for this, and then down here it plays for this, back in the upward direction, right? 151.75 potentially holding as that higher low reversal. Let's move on into the metaverse, and this one, a lot of overhead supply from the shoulders of the head and shoulders, something that looks like this, right? So Meta could be a possible rejection contender near the daily 200 SMA. This one, because we have a helper level from these sets of lows back here, which were also the gap fill lows and the daily 200, so 574 is your number. Consolidation here, that then Brigade bolts underneath, that's just like Google, another instance of where I would be willing to take the short on a possible move for the pullback. I'm willing to participate in both of those instances, right? When we get to 550.50, that is where I would say, okay, if possible, seeking a higher low. And we'll just rinse and repeat everything we've talked about, right? Here's your double bottom, there's your neckline, so on and so forth. Moving along to Tesla, Mr. Musk and the dark horse pulling out here a little bit, but not as much as I would have liked to see. Honestly, the weekly daily double bottom that's happening here, this is now a weekly double bottom like this, right? It's going to require a little bit of effort to get over that neckline, over the moving average cluster around 286.85. It would have been best if this could have remained constructive for a stair step here, and we started building another one to the upside. So we'll give it a little bit of the benefit of the doubt, just noting that the lows here were not substantially lower than what we had in the rearview mirror. Remember that Tesla was already down nearly 50% from its recent local high. The damage was done, so to speak. And actually, quite a few comments in last weekend's video, people not a fan of me saying that, thinking like, no, Tesla's going to go to zero. Okay, sure. But for now, this recovery over 250.50 certainly strikes me as an opportunity to look for a higher low pullback, maintain price acceptance in the upper range, and see if the weekly double bottom is going to play out. If it does, boy, oh boy. I mean, look at this thin structure retracement. I'm very interested in getting over this area to start targeting things like 326.50. Let's move on over to JP Morgan earnings on Friday morning before the bell, so please do be mindful of that. Let's go to a daily chart here. Very similar to, obviously, the XLF chart. I will say that there's some better improvements out of JP Morgan versus the XLF. I like the fact that we're over this pivot low from back over here, and that can now act as the next possible higher low in the trend count. And we have a gap to close overhead. So I think the risk management component of actually trading JP Morgan, if you're interested, is quite clean here. If we can hold over Tuesday's high, right, you can look for longs off of that or against that to ultimately target the gap close. If you just want to target this, then great. Hopefully the risk reward is tight enough for you on something like a 5 or a 2 minute chart. If you're not interested in taking that as support, then fine. The gap close overhead is still interesting as a possible breakout trade for risk reward 235.20 into 241.25. Here it is in the hourly, and you can see that straight up move. Again, not unreasonable that we would set the higher low here, but the gap fill overhead is very interesting. Still on the table, earnings, maybe bump it out in terms of your options. We'll reevaluate the chart when the numbers come out. Let's finish up with Netflix here and then 2 trade ideas and you're on your way. What do we have out of Netflix? We've certainly got a strong rally to the upside. However, I'm not convinced out of Netflix. If I do something that looks like this, we're still underneath this neckline here at 950.25. So I'd prefer out of Netflix, honestly, a bit more of a higher low pullback that then says, okay, here to here, higher low. You're no longer coming from the lowest low because you are technically, right, from here to here. And it's not as... I don't like this chart structure as much, and maybe it has to do with just the degree of sideways chop that we've sort of seen through some of these tests. I'm not as thrilled about the structure in here, so don't get me wrong. The levels are fine. There's nothing wrong with the levels, but in terms of being interested in actually taking the trade on Netflix, a little less desirable to me at this particular point. Let's move into these two trade ideas. Let's start on the daily time frame charts for each of them. AVGO is going to be first up on the chopping block. Broadcom, look at this thing, levels all over the place. However, if the market pulls back, notice that Broadcom is very, very cleanly right at the overhead supply here, right? So what I would be thinking about on Broadcom, if we go down to the hourly time frame chart now, is if we could get a little bit of a pop over 187 that fails, and then we move back down underneath, this is where I would look for the pullback risk reward into this previous level here at 177.75. You can even see the lower wick. Let me really zoom in on this so you can see it. Lower wick here, upper wick there. It's an inflection point. Certainly worth respecting at 177.75. So if you want the quick draw McGraw trade, AVGO Broadcom on a lower high, look above and fail at 187 seems reasonable. Seems like a reasonable setup, and we will target about 10 points lower, 177.75. That's the first one. Now, if you're like, you're insane, you've just been talking bullish about this the entire time, well, again, note the difference. It's the precision to the test and the precision of the lows of the previous balance. And even if you don't want to take the short, that's fine. You could say, okay, I'm looking for this, and then you want longs off of 177.75. If the broad market's really going to make a break for it, right, I would say that this is also on the table as a possible trade setup. Okay, that's AVGO. Next up, we have Walmart, WMT. Let's take a look. There's a couple levels in here that are worth noting. This consolidation range, right, was closed above, whereas everything else, or most things out there in the market, right, we've clearly closed underneath consolidation ranges. So that's checkpoint number one. Bulls are making a stand there. If we pull back, the top end of that range gets very interesting. If you want to be precise and use the double bottom neckline from the hourly, that's 86.60. Now that we understand the daily context, right, let's go down to the hourly. So I would say if we pull back off of 90.25, I would be looking for buying opportunities here, rotate back to the equal high, if not through the equal high, thin structure retracement. We just saw one singular daily bar there. That's 94 as a target. The other opportunity is just you get consolidation here. It doesn't really offer a short to get to here. It doesn't really pull back and give a long setup off of this zone. Fine. Over the level with a Brigade bull intraday, you're also available for longs at 90.25 into 94. All right, and that is today's episode of the Midweek Market Update. If you enjoyed the video, if you're having a blast trading this volatile market, then let me know down below in the comments section. If you're also like, dude, you're just too easily swayed back to being the perma bull of YouTube, you can also let me know in the comments section, and I'd love to hear from you. But don't just say like, yeah, you're too bullish. Give me some data points. Tell me exactly what you're thinking is going to send the market back to the downside, and tell me why I shouldn't be looking for support here at 523.75. Tell me why the technical structure is incorrect. Tell me why the supporting evidence that we just walked through was incorrect. Right? I'd love to hear an opposing take. Right? Not to say that my take doesn't always have to be right. It's not right all the time. We know that. But I just want to know your data points. I want to know the info to back your claim. So that's going to do it for today's episode. I hope you enjoyed it. Once again, let comments down below, all that good stuff. Thumbs up the video goes a long way to support the channel as well. And we'll see you back here for coffee and donuts tomorrow morning, 8 o'clock Eastern time on the channel for the pre-market prep. Hopefully you have a green trading week, and I will see you in the next one.